How are you paying taxes in retirement? How are you withholding taxes from Social Security, from pension? What about dividends? Can be complicated. I've got a solution for you. That more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. When you're in your working career, paying in the right amount of taxes is normally pretty easy. Most of your income, if not all of your income for the majority of us, is coming directly from your paycheck. And as long as you have the right W-4 filled out, that's what the form is called. Many people say W-2 or W-9. No, it's W-4, where you've got the right exemptions. That's the old word for it. They've got a new form that you fill out. As long as you're withholding the right amount from your paycheck, that's pretty easy. All of your taxes are withheld from your paycheck before you even get your hands on any money, before that money gets direct deposited in your account. And then you show up and get your taxes done and everything's, close to break even, or you get a little refund or whatever. Not a big deal. If you've got other investments that create dividends or have a lot of interest or capital gains, say you own a rental property or own a business, there's a little bit more tax planning that you need to do. Those pieces might require that you pay some tax estimates or increase your withholdings on your pay stub, but fairly easy to manage for the majority of us. Well, when you transition into retirement, for the majority of us, it's not easy to manage, okay? Because all of a sudden you've got maybe Social Security, not maybe, you're gonna have Social Security, you might have a pension, you might have IRA withdrawals. Those IRA withdrawals might be lumpy. They might not all be the exact amount, same amount every single month. You might take a little bit every single month and then a chunk here or there. And therefore, knowing how much tax you should be withholding and having it withheld appropriately is a significant problem for folks in retirement. And with Social Security, the complication is hopefully not all of it is going to be taxable. How Social Security is taxed or determine whether it's taxable is it's based on a formula of, and it's modified adjusted gross income, blah, 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 but basically all of your non-Social Security income sources, so all of that, add it all up, plus half of the Social Security that you had, you and your spouse. If that formula equals a number that's above a certain level, then some of your Social Security starts becoming taxable. And then if it's above a higher level, then the majority of your Social Security becomes taxable, 85%, okay? And these are small windows, okay? If you're married filing jointly, if that formula is above, I think it's $32,000, then a chunk, Social Security starts becoming taxable. If it's above $44,000, then up to 85% of your Social Security is going to land on your tax return and be taxable. And so, I'm just sort of overgeneralizing there, but a lot of people don't have taxes withheld, federal taxes withheld on their Social Security because it might not be taxable. Not all of it's going to be taxable. And it's going to depend on my other income sources. And so unless you're in a position where Social Security is going to be taxed, 85% of it will be taxable every single year like clockwork, then you might want to withhold taxes on it. But most people don't. I'm just going to say most people don't. If you've got a pension and they're going to withhold federal taxes, but they're only going to withhold taxes based on whatever W-4 you fill out, and it's normally your pension income is going to be pretty small compared to your total retirement income, so they're not withholding that much. If you've got dividends, interest, capital gains, which is more common when you're in retirement, there's no tax withholdings on that. And then your IRA, like I mentioned, anything you're supplementing, you're withdrawing from your retirement accounts to supplement your other retirement income, you might be withholding a little bit on that. You might not be taking those IRA withdrawals systematically. You might take them in chunks. So how do you handle the tax withholdings? Well, the right answer is tax planning. Working with your CFP to get proactive about your tax situation so that every single year you're doing a tax analysis to say, all right, what's the tax picture going to look like? And therefore, we're going to owe about 12 grand in total, like federal taxes. Where should we withhold that? How do we pay that in? You could do estimates. You could set up withholdings from Social Security. You could do lots of things, but what's the right plan for you? Well, there isn't a right plan for everyone. So that's why you need that proactive tax planning work, especially if each year in retirement might look a little bit different. Well, this year we bought a car and we need to withdraw some extra dollars from the IRA. This year we actually took a big trip that we needed to withdraw some extra dollars. This year we didn't do anything, so our IRA withdrawals were smaller. So you want to do that proactive tax work with your CFP. This year we did a Roth conversion. So how does that impact things and impact our withholdings? You need to do that proactive tax planning work. Now, once you reach age 73, used to be 70 and a half, then it went to 72, now it's 73, on its way to 75, your required minimum distribution. You've been retired now for maybe a decade, and now you're required to start drawing money out of your IRA. If you already have been, then you've already got a system figured out with your CFP to withhold the right amount of dollars. But if you haven't been, and now this required minimum distribution feels like a nuisance, well, we don't really need this money. An idea is look at your tax picture and do all of your tax withholdings from your RMD. Therefore, you don't need to worry about withholding taxes on your Social Security or your pension or your other IRA withdrawals, and you don't need to worry about doing tax estimates. For most of us, again, it depends on your situation, on capital gains or interest dividends, that sort of thing. You can, every fall, take a look and do a mock tax return. We call it a tax projection. And take a look and say, well, here's what my tax picture is likely going to look like, including the amount that I need to take out for my required minimum distributions. And here's the total tax. And hopefully, or assuming that the total tax is less than your required minimum distribution, then you just take your required minimum distribution out and withhold it for taxes, and that has you covered. And that can increase your cash flow every single month by not needing to withhold it from the pension or Social Security, not needing to withhold it from the supplement that you're drawing out of your IRA, and not needing to do estimates. Recently did this for some folks where they haven't been withholding on their Social Security, they haven't been doing some of these other things, and we took a look and their required minimum distribution was 25 grand. And when we were doing their tax analysis, they needed about 18,000 paid in for taxes. Well, there you go. When we do the required minimum distribution, now I'm not going to do it until the fall because I don't know, they might take a little bit more out of their IRA, things might change, something like that. But we're going to update that analysis in the fall, and if all of that math still works out, then we'll take the required amount of $25,000 out of the IRA, we'll withhold $18,000 for taxes, and the remaining $7 grand we'll either send to their checking account if they want it, or we'll reinvest it into their joint account if they don't need those dollars. But we're taking care of all of their tax withholdings with their required minimum distribution, so it frees up and makes cash flow super easy through the rest of the year. Does that strategy make sense for you? It may. Work with your certified financial planner. Make sure they're doing tax planning with you. They've got to be doing investment planning with you as well, helping you with your required minimum distribution, helping you with your present financial position so that you understand your cash flow and they understand your cash flow, can take that into account, and all of the other 6 areas of your overall financial life. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.